Welcome to Mind Over Markets. This channel is about trading psychology, not from a textbook, not from a professor, but from my real experience as a trader. I've blown accounts, I've let emotions take over, and I've learned, the hard way, that trading is much less about charts and much more about mindset. Today, we're tackling the most common psychological trap out there, FOMO, the fear of missing out. This single mistake has ruined more traders than bad strategies ever could. FOMO in trading is simple to explain, but incredibly hard to fight. It's that moment when you're sitting there watching price move without you. Maybe it's a big green candle shooting upward. Maybe it's a breakout you didn't catch. Maybe it's a reversal you thought was impossible, but now looks obvious. Your brain screams, if I don't jump in right now, I'll miss the trade of the day. I'll miss the profit. Everyone else is making money except me. And so, instead of waiting for your setup, you chase. The impulse feels irresistible in the moment and almost always ends badly. I can tell you from experience, FOMO doesn't just cost you money once, it sets off a chain reaction. One of my worst examples was with gold. Price had already made a huge run-up. I had told myself all morning that I'd wait for a clean pullback before entering. But the more it pushed higher, the more I felt like I was falling behind. I watched the candles stack green bar after green bar. Instead of following my plan, I overrode it. I convinced myself, this move is still going, I have to be in. So I jumped in. No signal, no confirmation, no proper stop loss. I even increased my position size, because I was so sure. And what happened next? The market reversed instantly. That single trade didn't just erase a win. It wiped out my entire morning's progress. But the real damage wasn't the financial loss. It was the mental spiral that followed. I felt stupid. I felt angry. And worst of all, I felt desperate. I thought, I need to make this back right now. That's when revenge trading started. I didn't wait for setups. I didn't check risk. I just kept firing trades, bigger and faster. Within an hour, I had turned a small error into a day I'll never forget. Not because the market was cruel, but because my emotions were in control. And once emotions are in control, discipline doesn't stand a chance. So why is FOMO so powerful? To answer that, we need to look at what's happening in the brain. When you see a market ripping higher without you, your brain releases dopamine, the chemical linked to reward and anticipation. Dopamine is what makes you crave the high of being in the move. At the same time, your amygdala, the fear center of your brain, is triggered. It tells you, if you don't act, you're missing out. That fear signal is so strong, it can override the logical part of your brain. The prefrontal cortex, which is responsible for rational decision-making. Neuroscientists call this an amygdala hijack. It's when the emotional brain bypasses the thinking brain. In trading, that hijack shows up as FOMO trades. Behavioral finance researchers have studied this for decades. Daniel Kahneman and Amos Tversky, the psychologists behind prospect theory, found that people feel the pain of missing out on a gain almost as strongly as they feel the pain of an actual loss. Think about that. Even if you didn't lose money, your brain treats not gaining as if you did. That's why watching a breakout you missed feels physically painful. It's also tied to loss aversion, the principle that we hate losing about twice as much as we like winning. When you see other traders winning, it feels like you're losing, even though you never had the profit in the first place. And then there's herd behavior. When you see a crowd piling into a trade, your survival wiring kicks in. For thousands of years, going with the crowd was safer than standing alone. But in markets, that instinct works against you. Now let's break down why FOMO is so destructive in trading. First, it kills your risk-to-reward ratio. If you're entering late, you're at the worst possible price. Your stop loss is far away, and your potential reward is small. Even if you're right about the direction, the math is stacked against you. Second, FOMO trades almost always happen at turning points. When a move looks the strongest, that's often when it's running out of steam. You're buying the top or selling the bottom, exactly where professional traders are taking profit. Third, and maybe most damaging, FOMO wrecks your psychology. one bad trade can be absorbed, but FOMO rarely stops at one. It sets off a spiral: frustration, regret, anger, then revenge trading. You start doubling down on bad decisions to make it back. Research from brokerage data confirms this. Most retail traders underperform not because their strategies are terrible, but because they overtrade chasing moves they shouldn't. It's death by 1,000 cuts. Mark Douglas, author of Trading in the Zone, said, "The market doesn't generate money, it simply distributes it. The ones who get it are the ones who can control themselves." Brett Steenbarger, a trading psychologist, often writes about how FOMO is a symptom of poor self-regulation. When you haven't defined your setups clearly, anything that moves looks like an opportunity. And Daniel Kahneman summed it up perfectly in his book Thinking, Fast and Slow. Our fast brain reacts to fear and opportunity automatically. Our slow brain, the one we need in trading, takes effort to engage. And most of the time, the fast brain wins. So, how do you fight FOMO? Here's what I've learned from both experience and from studying how professional traders handle it. First, rules before market. I pre-plan my sessions. That means writing down in plain language what setups I'm looking for and under what conditions I'll trade. Professional traders call this pre-commitment. By deciding when I'll trade before the market opens, I protect myself from emotional decisions during the market. Second, I scale risk consistently. FOMO makes you want to size up to chase a big move with a big position. But pros keep risk steady, often just 1 to 2% of account equity per trade. If the trade isn't part of the plan, it gets zero risk. No exceptions. Third, I use alerts and automation. I don't sit glued to the chart, because staring creates temptation. I set price alerts at my levels so I can step away. Some traders even place limit orders at key levels, so execution happens only if the setup truly triggers. Fourth, I reframe missed trades. Instead of saying, "I missed it," I now say, "That wasn't my trade." That mental shift is crucial. If a move didn't meet my rules, it doesn't belong to me. That simple reframing keeps my psychology intact. Fifth, I journal not just trades, but urges. If I feel FOMO, but resist it, I write it down. Over time, I build a record of moments when I had the discipline to say no. It's proof to myself that I can control my impulses, and that builds confidence. And finally, I focus on process, not outcome. Pro traders know that one trade means nothing. What matters is executing edge consistently over hundreds of trades. When you adopt that mindset, missing a single move doesn't hurt. It just means you're sticking to process. So, that's my take on FOMO, the account killer that's blown up more traders than bad strategies ever will. Thanks for watching Mind Over Markets. If this helped you, subscribe for more episodes on the mental side of trading. And follow along as I share the lessons I've had to learn the hard way.